Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CK Asset Holdings Limited annual report. CK Asset Holdings Limited offers a diverse range of businesses and services across various regions. The company's primary focus is on property development, leasing and investment in Hong Kong, the mainland, Singapore, the UK, continental Europe, Australia and Canada. The company provides property-related services such as office, industrial, retail, residential, and other properties for lease. It also engages in property investment and development activities, including pub and hotel operations. Additionally, CK Asset Holdings Limited offers property management, finance, and agency services to its clients. Furthermore, the company invests in infrastructure and utility asset operation, expanding its portfolio beyond traditional property development. This diversification enables CK Asset Holdings Limited to tap into new revenue streams and capitalize on emerging opportunities in various markets. CK Asset Holdings Limited market capitalization of $162 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that CK Asset Holdings Limited holds a significant advantage in their industry. CK Asset Holdings Limited trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 0.41 times relative within the industry. This suggests a potential market detachment, as CK Asset Holdings Limited trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 3.76%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, a significant increase in property sales revenue was observed, with a 105% rise from $9,958 million in 2024 to $20,414 million in 2025. This growth was driven by strong performances in Hong Kong and mainland China, as well as increased overseas sales in Singapore and London. Additionally, the relaxation of home purchase restrictions, reduced minimum down payment ratio, and lowered housing loan interest rates in the mainland contributed to growing interest among prospective buyers in mainland property projects. In Hong Kong, stamp duty reductions, lower mortgage interest rates, and competitive pricing also boosted sales. Furthermore, the company's joint ventures with ISTA JV, UK Power Networks JV, and CK William JV saw significant increases in revenue, ranging from 2.5% to 9.7%. Overall, the group revenue increased by 27% from HK$45,529 million to HK$57,935 million. On the other hand, the primary drivers of revenue decline were largely due to market conditions and operational factors. The low contribution margin due to discounts given for sales promotion in weak market conditions led to a decrease in revenue. Additionally, provisions made for the sales of Blue Coast and Blue Coast II also contributed to the decline. The rental income declined by 2% from HK$6,135 million in 2024 to HK$6,020 million in 2025, while leasing of retail and office properties in Hong Kong remained stagnant. The Shanghai Westgate Mall and Tower ceased to provide rental income, further contributing to the decrease in revenue. The company's financial performance indicates that it is indeed generating positive operating cash flow. This is a significant indicator of its ability to sustain itself and make investments for future growth. The generation of positive operating cash flow suggests that the company's revenue exceeds its expenses, allowing it to retain earnings and invest in new opportunities. The economic performance of various regions and segments in the given data reveals a positive trend. The mainland region recorded a notable 5% real GDP year-on-year growth, indicating a strong economic expansion. Similarly, Hong Kong also experienced a respectable 3.5% real GDP year-on-year growth, showcasing its resilience in the market. These results suggest that these regions are performing well, with the mainland leading the way in terms of economic growth. Management is optimistic about the company's outlook, citing several key strategies that will drive growth and unlock underlying value. The company plans to dispose of non-core assets and reallocate capital into more promising investments. In specific business segments, management is confident in the demand for premium office buildings, with a focus on leasing strategies at Cheung Kong Center II. The company is also adjusting its portfolio to maximize revenue from hotel and long-stay operations, while driving business performance through digital investments and efficiencies in its pub operation. Additionally, infrastructure and utility asset operation is expected to see a steady increase in revenue due to stable and recurring income from regulated utilities. Management has made progress in stepping up sustainability and climate resilience, with a strong return on investment anticipated from the divestment of UK Power Networks. The company will continue to adhere to its principle of advancing without foregoing stability and maintain its strategic focus on delivering long-term shareholder value and sustainable growth. Hong Kong and the mainland remain important markets for the group. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has expanded its portfolio by purchasing elderly care and assisted living homes in Germany, supported living housing in Sweden, and agricultural land in Australia that is designated for carbon sequestration. These acquisitions demonstrate the company's commitment to diversifying its assets and exploring new opportunities in various sectors. The purchase of agricultural land in Australia, specifically, highlights the company's focus on sustainable investments and environmental initiatives. On the other hand, the company has also engaged in divestitures by disposing of its interest in UK Rails in January 2026 and proposing the disposal of its interest in UK Power Networks in February 2026. These moves suggest that the company is streamlining its operations and focusing on core areas of business. The company's financial performance is reflected in its dividend payments. According to the provided information, the company has indeed paid dividends. Specifically, page 23 of a report states that the company paid dividends. Yes, with detailed breakdowns for interim and final dividends in both 2024 and 2025. This indicates a consistent commitment to returning value to shareholders through dividend payments. That concludes the financial summary for CK Asset Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.